If current conditions of the stock market being down and your retirement investment accounts falling in value have you concerned, worried, or even scared about your future, well, you're not alone. Today's episode is just for you. Jim Manning is back with me on the podcast. As a reminder, Jim is an investor and a retiree, someone just like you. And we're talking about market conditions, managing investments in a down stock market, how to help know if you're on track to being okay, and stick around to the end because we're going to talk about opportunities that everyone should be looking for in a down market.
Welcome to the Your Life, Your Money podcast with Scott Searens, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Your Life, Your Money podcast, where we discuss thoughts, strategies, and actions to help you thrive in life, wealth, and retirement. I'm Scott Searens, and today Jim Manning is back with us on the podcast. I think you'll really enjoy hearing from Jim again, as he is an investor. He's had a successful career, and now Jim is a retiree. So Jim is sitting in your seat, or sitting in that seat that you want to sit in the future as a retiree. So first off, we really appreciate, we got some really nice emails, Jim, after our last podcast together. Some folks that emailed in and said that it was really helpful. And one of the things I just wanted to throw out there is that if people are finding our information to be of value and benefit, what helps other people find the podcast and find this information is if people would go on to iTunes, and which is Apple, right, and leave us a review, right? So if they'd go on there, leave us a review. Now, of course, that those 5-star reviews are really nice, but if they just leave us an honest review on iTunes, that would be super helpful, because that helps other people just like you find the podcast and find all of the valuable information that Jim and I are hoping to help others out on. So Jim, welcome back. How are you doing? How's things going in your world?
Hey, I'm doing great, Scott. Up here in Michigan, enjoying this beautiful Michigan weather, 82 degrees, sunny. Trees are full bloom, leaves are out, and I'm ready to go fishing.
That's great. That's great. And hey, last time we talked about your grandson, Jake, all-star, right, of all-star sports player. And I think we're full swing into baseball season now. How's that going?
Now he's doing good. He had some kind of a baseball clinic this past week and got some kind of a batting championship trophy as a top batting average for the week. So that made Grandpa pretty happy.
I bet. Yeah, that's got to make you proud getting those pictures in, right? You forwarded it to me. That was really cool to see.
Yeah, it was cool. He's 12 and they're starting to play a little better ball now. And I played a lot of baseball through high school, and so I really enjoy it. And
I know you said you got on the boat. Was it a week ago or 2 weeks ago? Did you catch any fish that day?
Yeah, I'd say about a week, 10 days ago, we went out, did some walleye fishing out here at Saginaw Bay, and I was able to catch some. I think we caught 11 walleyes, and can't wait to put them in the pan.
Awesome, good stuff, very good stuff. Well, Jim, I'm going to turn it over to you. I think we've got a great topic for our listeners today, but I'm going to turn it over to you and let you take the lead, and we'll let you take over here.
All right. Thanks, Scott. I thought it'd be a good opportunity today to just discuss, what's going on today in our environment. Been talking to a lot of people lately, and it seems like invariably the topic of the stock market and their investments comes up, and they're really concerned about the market declines we've seen over the last couple of weeks and all the negative things that are happening with inflation and the gas price and everything else. So thought that maybe we could talk about what's some of the advice that we can give, or you could give people to help them deal with this stress during this downturn when they look at their portfolio every week and it keeps going down and down. So what are some of your thoughts and how to put some of their mind at ease?
You mentioned some words in there, right? Really important, just the emotions. And I think if you would agree, one of the main things right now is that the stock market, yes, it's unfortunately, it's gone down since the beginning of the year. And it creates a whole lot of emotions. I mean, I know that we've had that discussion that you're an investor. What kind of emotions are kind of running through your mind right now, Jim? What do you see out there when you're talking to people?
Yeah. Well, the emotion is like, I'm in retirement age, right? I'm in retirement. And so the emotion you have is, what is this going to do to the amount of money that I have to retire on? And, should I be looking at selling some stuff before it goes down too far? Fortunately, I don't have those emotions. I don't have those concerns now because I was able to put together a financial plan that was able to provide a war chest or a rainy day fund. So I don't have the stress that I see other people who don't have that opportunity, don't have that fortune to have a war chest with money they can live off to get them through this downturn. So it affects, I look at it a little bit different right now because I have that plan than I think a lot of people have.
Sure. It doesn't matter, right? Anytime we see our account values go down, it still drives emotion within us personally, because that is something that, we've worked so hard to save up. And, I see sometimes just out there in articles, or as you do, talking with different people, right? Some people say, hey, this is scary. This creates concerns, which to me leads to the fact of kind of back to what you talked about is, okay, well, was there a plan in place in the first place? Because if not, then a lot of times those emotions tell me there might not have been a strategy in place. There might not have been a plan in place. So when dealing with those emotions right now, one of the things I really like to try to help people focus on is perspective, right? Because I get it. Sometimes we can live so into the now of what's going on in the TV. And then you hear the TV, the people on the news go, oh, the Dow fell 800 points today, or it fell 1,000 points today. And they're telling you the records of, we haven't seen, this many days with a decline in the stock market. And then all of that can just become real, build up those emotions even further to just drive concern. And a person hasn't even, maybe even opened up their values yet to see where do they even compare to what they're hearing on TV. So I think, first thing is perspective, and it's getting out of that short-term perspective and getting more into that longer-term perspective. And here's what I mean, when you think about what's going on now, Jim, and I mean, we're in, kind of end of June as we're recording this here, and the market's been somewhere around 20% down. When you look at that, and if we were to kind of try to think a little bit differently about this, instead of just looking at it where it's down at today, let's kind of maybe change our thought process a little bit. First off, do you think that it will come back?
Yes. Based on historical, history, that markets always bounce back. So,
okay.
It's just a matter of, when is it going to come back?
Okay. Yep. And we don't necessarily maybe have the answer to that question, but let me just ask you another thought process. I know there's a lot of talk in recession. There's that hey, are we headed to a potential recession or not? Interest rates are going up. From everything that's going on, and now with the market being down, how long? And this is, I get it, total guess, right? But just how long do you as a person feel that this will last? The market being down, or if we're to get into a recession, or they call this right now a bear market. How long do you feel that this could potentially last?
Well, Scott, looking back at things, and I've read a lot about recessions and so forth. And so my knowledge tells me, or my feeling tells me that somewhere, the market will probably bounce back in 12 to 18 months, maybe 2 years. But as bad as the recessions that we've had in the past, all of those have bounced back in a reasonable amount of time, usually within that time span of around 18 months. So that's what I'm thinking will happen.
And you see how we've just taken what seems maybe scary today, this 6-month period so far this year, and now all of a sudden, and we're just kind of, putting into the potential future. And you're saying, hey, maybe, what was it again, Jim? How many months?
Well, a year to 18 months on the average, somewhere around 18 months, maybe a year, a little bit more, a little less. Maybe it's 2 years, but it's not, it's not a long term.
It's not forever, right?
Not forever.
I don't think it's going to be forever. And so now all of a sudden we just taken this with this scary 6 months and we're saying, hey, we could potentially be out of this in a year and a half. Now, it could be scary if we don't have a year and a half of, funds set aside to help us last through this period. But part of what I do with my clients, you had mentioned, how you had kind of constructed your plan earlier, is setting aside that war chest, that pool of funds, whether it be cash or, funds that aren't subject to that similar volatility of, equities or stocks in the stock market. That way you've got an area to go to, make those withdrawals, keep that retirement income coming in while we weather out that storm, whether it is, a year and a half or longer, but we've got that location to go to. And just looking at some quick statistics here, and I'll put them all in the show notes. So people, there's different things we'll talk about today. People can go to the show notes. So they go to lifemoneyshow.com. Again, lifemoneyshow.com. Go to the show notes. We'll link to this here, but Hartford Funds had an article. They said a bear market. So bear markets, when it hits 20, when it drops 20%, bear market happens every 3.6 years, and the average length is 9.6 months. So not even a year.
Right.
Since World War II, it actually has happened every 5.4 years. So I think, while this seems scary, another thing just to bring up is that, okay, if you're concerned, like we mentioned earlier, maybe you need to get a plan in place. Maybe there wasn't strategy behind the dollars, because the other thing to think about is, and Jim, you're in your mid 70s, right?
Yes.
And you said your father lived into his 90s?
Yeah, 99.
99. So, wow, that's awesome. What an awesome life, huh?
You bet. Lived a great life.
He was a sailor?
Yeah, I sailed the Chicago Mackinac races 11 times.
That's 11 times. That's super cool. So think about this. And I hope you have a nice, long, healthy life too. You're looking 20 to 30 years. I mean, that could be another 5 to 6 of these bear markets that you might see in your retirement.
Absolutely.
Or more. And so I think it's just to part of those emotions is really taking this and putting things into perspective, trying to get ourselves out of that short term, asking ourselves that question of how long do we think this will last? And then do we have the funds put aside to help weather that storm?
Right. So let me ask you this. If you're a person, say, in their mid 40s versus a retirement person, is there different advice for those age groups?
Yeah. And I'm going to throw another one in there. So age 40, if you're 5 years away from retirement, or if you're retired. So age 40, I look at this as a buying opportunity. And I know you're a fisherman. So if I gave you 2 stores, if I gave you a store A where you could go buy your fishing gear at, or store B, and you can get the exact same gear at both places, but store A had your fishing gear on sale and store B was more expensive, which store would you go to?
Store A.
Hands down, right?
Sure.
And that's the stock market right now. You've got basically a store of stocks that are on sale. If we believe, which I do, that they'll be, higher in the future, then right now stocks are on sale. So I look at this for a person who's, in their 40s, I look at it as a buying opportunity. And, now could be a great time to try to put more aside. I've had a few conversations with clients that, I said, hey, knowing that they are big savers, we talked about them actually taking and upping their 401k contributions right now while the market's down, and trying to front load what's going into their 401k this year and taking advantage of the market while it's down. The retiree portion of that is, and I know this is sometimes the hardest advice to take in, but let's just assume that a person has that plan in place. Then, my thoughts towards a retiree right now is, hey, we need to hold on to that plan, right? And sometimes it's the toughest information, but it's that information that's telling you to do nothing. Assuming the person had a plan and strategy like like we were talking about, right? Where you can weather that storm. And here's how I'll relate it. And I'll relate it using yourself, Jim. I know that you recently broke a bone, right?
Yeah.
And when you had that injury, how long did the doctor tell you to stay off your legs for?
So the doctor said to stay off of the leg for a total of 8 weeks, but at the end of 6 weeks, I could start putting weight on the leg gradually and then work up to the 8 week level of period.
Okay. What do you think would happen? Is it at 2 weeks or 3 weeks if you were to just go out and put weight on that leg and just like go back to normal?
Well, you could risk damaging that bone further. That fracture I have could break off and become detached to the plateau part of the tibia, which would require surgery and put some bolts and screws into it. So it becomes a major operation.
And that 8 week recovery just became how long, would you guess?
Oh boy, 6 months probably.
6 months. I'm telling you, the market is just the same, right? It's like we have this pain of being down, and sometimes that, just like you wanting to get on your legs so bad, because I know you're a very active person and you love to fish and love to go see Jake play ball, right? We want to be on our legs so bad that we're like, okay, we want to do this, right? It's just like the market being down. People just want to, we're talking about people having that, being stressed about it or concerned. What do you think brings them comfort? Selling, right? It's just like, finally, I relieved the pain. But if they do, when do you get back in? And it's impossible to know the two right answers to that question. So it's just kind of like what you're going through with the doctor. If you take that wrong turn, meaning selling your stocks while they're low to, during this thing, now your recovery or getting yourself back up to even could take even longer. And we wouldn't know what that is, because when do you get back in? Then you need, market appreciation once you do get back in. I look at it very similar to what you're going through right now in your recovery process, is that even though it's really painful, it takes time, and we got to just take our time to go through it. And like you had mentioned earlier, and I believe too, this isn't going to last forever.
Yeah, that's a good point. Good analogy. You've talked about the importance of having a rainy day fund or a war chest and so forth to weather this out. But in the event that people don't have that war chest or didn't put it together and don't have it at this point in time, how, and let's say that a person's retired and he needs money and he's drawing money out monthly out of his retirement funds to live on. How does he decide how much money to withdraw? Or should he be looking at drawing enough out to last him several months or a year, or just month by month? And how does he determine if he should sell bonds or sell stocks?
I think that's a great question. And probably a lot of people are, some people are finding themselves in that position. And, I think at the end there, you broke it down into really two good parts. First off, let's just say they had, maybe carved off some in bond funds or in bonds. And I get it right now. Bond funds are down. However, they're not as far down as probably a person's equity position. And so right now, I guess, yes, if you had to go and get funds, you're going to want to start with what hasn't dropped as much. Plus, I'd want to look at what has more opportunity to rebound as the market comes back. And to me, stocks would have more opportunity to rebound than the bonds will, just from historical perspective. And I kind of, think about it this way: is that, like, if you had a spring, and that spring compressed, which that's the market right now. You've got this spring, the spring compresses. And let's say while it's compressed, you start to cut layers out of that spring. Well, you're cutting its ability to bounce back to its full position. And that's what you'd be doing. If you're selling stocks while they're down, you're cutting into your spring's ability to bounce or rebound back. And that's why I'm saying you don't want to cut into the one that's compressed more. You want to take that one that's compressed less. You want to go to the bonds there. I'd also say, which you had mentioned, is like, how much should I sell and when? I think just like averaging money out, if you weren't if you were not prepared for this, I think take out only what you need. But overall, I'd say sit down with somebody too, because, taking out too much right now could impact a person's future income and future withdrawals that they, might be able to make. And so, yeah, I would say kind of average it out and averaging out only what you need, if you didn't already have a strategy and a plan in place.
Right. So is another option would be to look at maybe a home equity line of credit or something at this point, or is that counterproductive?
That if you needed large lump sum withdrawals, that could be something to look at. We had a client that was moving, from one residence to another that needed a large lump sum withdrawal that, would be repaid in a short amount of time. They weren't going to be sitting on this withdrawal for a long period of time, or that interest for a long period of time. So we used something like that to help them get point A to point B. However, yeah, I'd say everybody's situation is unique and different. And so if you're taking out a loan, you got to be ready to be able to pay it back. And when does that come? What does that interest look like? Sometimes too, these home equity lines can be flexible interest rates. So while it might start off, where you think you're starting off at a comfortable rate right now, that rate, because we continue to hear from the Fed that they're going to continue to push interest rates up. So you have to be prepared not only to be able to pay that interest today, but what could that rate be in the future?
Very interesting. Good points. So it looks like we've discussed some things that we could be looking at and doing as we look at the market and some of the downturns, to put some things in place. But it sounds like what I'm hearing is maybe the best advice right now for people is sit down with a financial planner and look at their portfolio and put together a financial plan that looks at all of these options and various things that you've talked about.
I think that's, really important, and we'll dive into opportunities in a second here. But, yeah, I was sitting down with a couple last night, and even though the market's down, it's still an opportune time because they're looking to retire in a couple years from now. So what we're doing is even though the market's down, we want to still make sure that they're able and ready to retire in a couple years from now. They're they just started working with us. They hadn't put together a plan before. And so now we're watching the market conditions and we're slowly carving off their war chest. So that way, even with and in these current economic times, it's not going to impact their ability to retire in 2 years, which is their target. And I think, sitting down with somebody and having that strategy, what I have found in working with my clients is that, similar to what we talked about earlier, is if there's a mental strategy, if there's a strategy in place that we can emotionally relate to, especially while the market's down, then that really helps us weather this storm emotionally. We've got the financial strategy in place, but it also helps us go through this emotionally, because then we're relating to our financial plan. Back to those questions earlier, we're talking about, okay, how long do we think this is going to last? Here's how much we've got carved off in the war chest. Do you think that's enough to weather this storm? Sure do. Great. We're going to continue to go on and enjoy our lifestyle. That's one part, right? Just from an investment standpoint. From an income standpoint, we're also putting together the income guardrails. So you almost look like two layers here of helping to just make sure people are, on that right track, or helping to make sure that they're on the right track through their retirement. And the income guardrails are, okay, if you look at driving over a bridge, a lot of times people look at retirement as like driving over this really narrow bridge and it doesn't have any sides to it. And if the market goes down like we're experiencing today, we're going to fall off, we're going to crash and burn, and everything's going to, just blow up. And that's not really how it works, or that's not how it works with our clients. It's like driving over a regular bridge. And as the market goes down, right? It's like driving off to that right side of the bridge, you hit a guardrail. And we put these guardrails in place, meaning if the account value is to hit a certain spot, then we know when we might need to take income reductions. We're not shutting off the faucet. We're not turning off the faucet. It's not crash and burn. We're just saying, hey, unfortunately, not your fault, not my fault, economic conditions and times. We just need to make a small reduction from the withdrawals. Is that okay? And we know what that is in advance. Does that still work from the plan for the plan? But, and on the same point, we want to make sure we've got our upper guardrail, because the goal is that, for me anyway, for all my clients, is I want them to go out and enjoy everything that they've worked so hard to save. And as the market rebounds, goes back up, when we hit the other guardrail, well, then we're reaching out and saying, hey, we've hit the upper guardrail. We now feel that you can afford to spend more. Would you like for us to increase the withdrawals that are coming out to your retirement account? So I think sitting down, getting the plan in place, getting those layers of strategy in place can really help people go through a time like today.
Sounds great. What about some of the opportunities that this market may offer us?
And I'm glad that you brought that up, because I think a lot of times we can get way too focused on the downside, right? On the value of our accounts are down. You and I want to come back to opportunities, but you and I have had a conversation about this before, of being down versus actually having a loss. And, it's not a loss until you sell and you lock in that loss. And right now we're just down. And if we put it back into that perspective, right, we believe that things will continue to come back up in the future. And so sometimes we can get so focused on the down that we forget to look at the opportunities. A few opportunities that we continue to look for with our clients. One is rebalancing the portfolio, which is getting into that mentality of buying low and selling high. So maybe rebalancing when it comes between your stocks and your bonds. Now, I realize they're both down right now, but stocks have dropped a lot more than bonds have. So there might be an opportunity to take some of your bonds and buy some stocks while they're low. Maybe you're out there and you were too safe in your portfolio. So if somebody was already way too safe or conservative in their portfolio, now would be a time to take from those bonds and put into the stocks, which my belief, or my opinion is that those stocks will rebound and give them greater potential over time. Looking at the different asset classes that you're in within your stocks and bonds, your mid caps and your large caps and your small caps. I think now is just a really good time to look at all of those. And is there a potential to rebalance and do the buy low, sell high opportunities? Right now it's more buy low, but are there opportunities out there like that? Next opportunity to look for is potential Roth conversions. And with Roth conversions, one thing that everybody needs to really consider up front is that when you do a Roth conversion, you're going to, pay the tax today, but as you pay that tax today, you're getting that money from your IRA into the Roth IRA. A reason you would want to kind of think about Roth conversions is back to my spring analogy, right? Right now, we've got that compressed spring. And if we all feel that the market's going to rebound back, well, if you do your Roth conversion while the spring's compressed and we shift that spring over into the Roth bucket, now you're getting that rebound in the spring in that tax-free bucket. So that's why that Roth conversion can be really powerful and impactful in a down market. And then the next opportunity that I would talk about would be tax loss harvesting. If you've got some down positions in your portfolio, it could be an opportunity to recognize those losses, which you would be able to take into your taxes. Now, I just want to make sure there's a difference between taking losses and tax loss harvesting. If you were just to sell and go to cash, that would be taking a loss. But if you were to sell and then put in a similar position, and there's a lot of rules when it comes to tax loss harvesting. So please, sit down with a financial professional and your tax consultant. But if you're to sell and go to a similar, not the same, but a similar position, now you've recognized the loss from a tax standpoint, but you still have yourself invested to bounce back up for gain.
That's really good advice. That covers a lot of ground there, and I think that that will reduce some of the emotional stress I think that people are having right now. And there's no need to have anybody jump off the ledge at this point. That's for sure.
No, and I think it goes back to perspective, and I think one thing too that we lose focus on, and most people, let's just call it, that are retirement age that have been investing have most likely been doing it for a while. I mean, Jim, how many years would you guess that you've been putting money into retirement savings?
Well, for 30 years.
At least 30 years, right?
Yeah. Okay.
At any point in time, did you actually keep track of every dollar that you put in? Would you be able to tell me, here's what my actual initial investment was?
Don't have a clue.
Right. And I don't either. And neither, I guess anybody listening here doesn't have a clue. And I guess this is the perspective I also want to bring to it is, let's just say you put in $1 million, right? You over time, you saved $1 million, but you've been investing this whole time. Maybe it grew to $2 million or $3 million. And now the market's down. And let's say that you put in $1 million, it grew to 3, but because you've been investing for 30 years, so it grew to 3. Now the market's down and you're looking at your account value and it says that it's down to 2 million, right? Or 2.5 million from 3. I think the other perspective that I want, folks to remember is remember you only put in $1 million, right? In my example here. And so you're still up. It's just right now it's down. And if we really focus on some of those things that we were saying earlier, my opinion, my experience, it'll come back up, but it's all about that perspective. And I get it. Some of these short-term things can cause concern, but hopefully today's kind of helped people to think about it a little differently.
Scott, that point you brought up, I think is really, really a very important point about people thinking they've lost money when the stock market drops like 25% of the portfolio. And they said, look at the amount of money I just lost. And I get that all the time with my friends. Look at the market. I'm down X number of dollars. And your point of saying, well, what was the amount that you invested? And from that point on, how much has appreciated? So you're not down at all. You're up probably 100% or who knows how much. But you don't lose any money until you go below the amount of money that you've invested initially.
Right. Yeah.
People don't realize that. I think that should put people's mind at ease. You're not losing money. You're just reducing a little bit of your appreciation that you've had all over these years of your investments. And it's going to come back.
I'd like to call it a temporary setback in your overall gains.
Perfect description.
Assuming people have been investing for a while and they've had gains, I look at it as a temporary setback in your overall gains.
That's a perfect description of it. I think that's a great tagline.
Yep. Good questions, Jim. What other thoughts are on your mind?
I pretty much wrapped things up, all the information and ideas that I've had. I think it's been an enjoyable time again, once again with you, and I've certainly enjoyed it. And hopefully, we've given some people some information to feel a little bit less stressful and less emotional.
Yes, I hope so too. I always hope people find value and benefit. I love our conversations and the fact that other people get to listen in. I hope they find it to be of good value and benefit as well. And if people do find these times scary, if they didn't have that plan in place, whether they're already retired, whether they're looking at retirement right now, if they're concerned, we've got a process that we go through with all clients. Our first visit together is our retirement design visit. What do they want their retirement and life to look like? And then our second visit is where we talk about their overall situation. We're talking about, opportunities that we see, potential pitfalls that we see, tax strategies, tax reduction strategies that we see. And really in that appointment, we're providing enough thoughts, strategies, actions to and a financial action checklist so that they can make an informed decision whether or not they want to work with us. And so I bring all of this up because if there is somebody out there where all of this seems like a lot that's going on right now, if they are concerned, they think this is scary, if they're wondering based on today's conversation, if they even have that strategy in place to weather the storm, happy to sit down and visit with them. And it all just starts with a 15-minute phone call. They can go to lifemoneyshow.com, again, lifemoneyshow.com, and they can click on the Work With Me tab. And we just start with a 15-minute phone call. And what I'm going to ask is, how can I help? That's going to be my question. I look forward to hearing from them of, what's on their minds. And then based on that conversation, I'm going to see if I can bring value and benefit to their overall picture. If I can, great. Then we go into that retirement design appointment. If I'm not the right fit, or if they need different help, then, my goal, Jim, is to point them in the right direction and, continue to get them going in the right direction. So if that's on your mind, again, you can go to lifemoneyshow.com, click on the Work With Me tab. Hopefully you've enjoyed today's podcast. So please subscribe. Jim's going to be back. We've talked about this earlier. You're going to find conversations with Jim at the end of each month. I think a lot of value and benefit hearing from somebody that is a retiree, the thoughts that are going on and, going through your mind, Jim. I know a lot of people can learn a lot from you.
Look forward to seeing you next month, Scott.
Hey, going to be another great conversation. I look forward to it too.
All right. Take care now.
Take care.
Sierens Financial Group is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through AE Wealth Management, LLC. AE Wealth Management and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein, provided by third parties, have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.
Jim Manning is not affiliated with Sierens Financial Group or AEWM.